A time-honored ritual before these meetings. Let me go to WIRP, the warp function on the Bloomberg, to look at the probability of a hike as priced in for the March meeting. 50% right now. I say it's a time-honored thing. What do we get from this? How predictive is looking at WIRP before these meetings?
Well, what's really interesting is it was at 40% coming into today, and Kaplan didn't really say anything that was especially different from what he had said before. He did highlight sooner rather than later as far as a hike, and whether it was that or just a combination of getting a little jittery, 2.5 weeks out, the market has started to price in a bit more of a hike, and the 50% threshold is really sort of indicative of whether the market's pricing in or not pricing in a meeting.
Okay, so maybe just barely there. Yeah. How much time does, there are a couple of weeks here until the next meeting takes place. Could the market change its mind conceivably in that period of time?
It seems that way based on today, but what was interesting was I talked to Jim Bianco, and he pointed out that, at this time, if the market's not pricing in a Fed hike, the Fed has never gone ahead and hiked. So it seems like potentially bond traders are really getting, their mojo, and they're really thinking like we need to start pricing this in because there is a lot still to come on the calendar before March 15th. You have Trump tomorrow, obviously, Stanley Fischer and Janet Yellen on Friday, and then you have a payrolls number that comes just 5 days before the meeting. So a lot can happen in a really short period of time.
Indeed, and you talked to Jim Bianco about that, or Jim Bianco wrote about that, the prospect of having that employment report coming in such short order with this Fed meeting. What does that portend potentially?
Well, what's funny is that just this past meeting in the minutes, it was revealed that Fed officials decided to extend their blackout period. So it starts March 4th this time around. So there's even less time for the market to sort of digest what's up in Fed's minds. So that occurs during the blackout period. So does CPI. So you've got the two core pillars of monetary policy that are coming at a time when nobody can really speak about it as far as policymakers are concerned.
Help us understand the import of that jobs data to bond traders at this point in time. You look at the panoply of economic data, generally pretty good. You heard Janet Yellen, the Fed chair, testifying before Congress about where she thinks the economy's at. How important is that one report? How important is it for the Fed to see a good report in next week?
Yeah, that's a good point. We see the unemployment rate's already very low, and it doesn't really move around that much at this point because it has dipped below 5% now. So what traders are really looking at is the wage growth element. They want to see inflation, and they want to see that as far as wage acceleration as well. So that's really the number that they're focused on. The last time a report came out, it was the wage growth that was the focus that caused the market to move, not the fact that the number of jobs that were created exceeded expectations.
How much of a raised eyebrow do bond traders have right now when Janet Yellen said this is going to be a live meeting and there's no press conference to follow? In other words, is that being taken as a sign that a rate rise will not happen because there isn't a press conference?
Right, yeah. May is a really interesting time because there is no press conference, as you said, but at the same time, it does seem to be sort of a happy medium between the people who are saying, oh, March is a really, it should be on the table, it should be live, and those who are really just saying, just wait till June. That's the next press conference day, maybe 2 hikes this year. May could be a happy medium where maybe they call a special press conference and they hike that and they leave the optionality of 3 rate hikes on the table. That seems to be, the chorus among strategists and analysts and traders is the Fed wants optionality. They don't want to be pinned into a corner like they have been year after year where they lose all credibility if they don't hike in December.